Hello and welcome to Hitting Home with Mike and Arif. And how are you today, Arif?
Never better, Mike.
Excellent. Today I thought we would talk about, and just to get this one out, mortgage myths and misconceptions. Say that
was a
three times
mouthful.
fast.
Absolutely.
Okay, and there are a lot of myths about your industry, and people approach me looking for homes, and then of course the next natural progression is to find that person's going to help you get your mortgage. And I want to talk a little bit about some of the misconceptions people have. And one of the first ones that people come to me about, actually even before we get to that, define mortgage broker to me. Tell me a little bit about what qualifies you to talk about what we're going to be talking about here today.
You know what? Great question. I'm glad you came up with the idea, Mike. Thanks for doing this. This is fantastic. I think
I had help.
Yeah, well, I think that if you just look at the world in general, right? I mean, we talk to our friends, we talk to our family, and we start batting around ideas. And the more we seem to talk about it in a small circle, well, then suddenly concept and idea must become fact. And we do that to ourselves in a lot of different topics, right? So this is certainly one of the biggest topics certainly that I deal with is misconceptions of clients who come in, and it's not misintention, it's not a bad thing. They don't come in with some sort of false tone. It's just, I heard from a guy who told me that this was the truth.
Yeah.
And so we have to
dispel that. If you're not dealing with it day in, day out, then you tend to hear these things.
Yeah. So what is a mortgage broker? Who is a mortgage broker? The simplest way that I could say it, and you obviously would deal with something similar as a realtor, but you're coming to me because this is what I do every single day. The average Canadian is looking at between 3 and 5 year terms on their mortgage. So by the time it comes to renew or refinance, your most recent transaction's at least 3 to 5 years old. Yeah, there are some people who do this every year for one reason or another, but typically speaking, it's about staying current with the information. Right. The other thing is why use a broker as opposed to go to my bank, and we're going to get into some of that. This is not about knocking banks, but the simple fact is
there is a difference, though. People need to
not
know.
only am I a mortgage broker, meaning I don't work for a single institution, I'm not loyal, I don't try to make you be loyal to my brand or my institution of lender that I'm going to align you with. However, I can certainly tell you we shop the market and we stay on top of the trends and what's happening in the market so that when you come to us, we have the most relevant, most current information. Here's the number one fact, though. If you go into any one of the branches, if you can tell me when the last time your representative who is going to help you with some mortgage information at the branch said to you, you know what, Mike, it is so important for me to make sure that you get the most suitable product for your needs, and that bank across the street on the other side of the street of the intersection, they've got a more suitable product for you. If you can tell me when that happened, I don't know, I'll give you $100 because I'm sure that's never happened.
It's a difference between the best product we have within these walls at the bank versus the best product that's out there in the market.
Out there in the marketplace. That's my responsibility to make sure that I help guide you towards the most suitable solution for you.
Yeah, and in that guidance, one of the questions I may have for you is, should I be going fixed rate or variable rate? Is one necessarily better, and is that a constant? Tell me a little bit about that.
Great question. So fixed versus variable, that's a question that comes up all the time, and we'll talk about which one's cheaper, et cetera, but fixed versus variable, just as a basic concept.
Yeah, explain what each one is.
Yeah, fixed rate mortgage, mortgages are typically closed, okay? Everybody says, oh, I've got an open mortgage. No, unless you have a line of credit, you don't have an open mortgage. Or unless you are paying probably 3 or 4% higher than you thought you were, you don't have an open mortgage. You're typically in a closed mortgage. But a fixed mortgage assures you that you've purchased peace of mind and you've purchased that your payment and your terms are going to be constant throughout the term or your contract, whether it's a 1 year, 3 year, 5 year contract, your payments are going to be the same, your interest rate stays the same throughout the duration of that contract.
Right.
Adjustable means that you're going to, as prime moves, so too shall your payment or your amortization.
So
there's variable and adjustable, two different things.
So depending on the market, it's almost like playing the stock market. If you're betting on the interest rates dropping over the coming term, you may want to go variable. If you're betting on them going up, then locking in may be in your best interest.
There are a number of factors, Mike. It's really important. I can't give it to you in just one sentence. There are a number of factors. For example, if you know that you're planning on moving within a year, then it doesn't make sense to lock in for a 5-year term. Because you're going to pay a penalty to break your contract, and that's going to be significant.
Right.
So even if you're going to pay a little bit more for the fixed rate versus adjustable, and I'm saying if, it's not necessary, it's not certain that you will.
It doesn't always work though. It depends which way the numbers are moving.
Even if you're paying for a little bit of peace of you're paying for peace of mind with the fixed rate, but you're paying for some flexibility that if it's adjustable and you need to break early, like you're not going to get a 1-year adjustable, you're going to get a 5-year adjustable because the penalty to get out's the same, 3 months interest. Okay. We got to keep moving with this.
So
but
when I do come in the door to you and we're discussing mortgage rates and fixed and variables, the other thing I want to know about is if I qualify. So tell me a little bit about pre-qualification and the difference between being pre-qualified and being pre-approved. And is pre-qualification a sure thing?
Sure, great question. The answer is absolutely not. It's not a sure thing. One of the things that we've talked about on this show for the last 3 years, Mike, is plain and simple, our goal is education of clients, right? We want our clients to be educated. So I always promote to my clients or to anybody I can talk to, even before you go shopping, meet with a mortgage broker. If you've come into a realtor, or if a realtor asks, have you been pre-approved or pre-qualified? First of all, they're not the same thing. Secondly, pre-qualified, really, in my opinion, it's a marketing pitch by the banks. It's dangerous, actually.
And the banks
because it
primarily
sets people out there on a track for failure more often than not. I can't tell you how many times a client has come to me in tears, nervous, stressed beyond belief, because they said, I bought a house, and I bought it 3 months ago, or I bought it whatever, and now it's a week before closing, and I was pre-qualified, and my bank's turned me down. I need to get financing. Can you help me? And so now they're in a real bind. So pre-qualification is the most basic of numbers that get tested. How much do you make, and how much money how much do you want to buy your house for? How much of a mortgage do you want? And plain and simple, it's not a deep dive. So if just because you get pre-qualified, it's a really loose term, it doesn't take into consideration the property that you're buying. And believe it or not, you're not just being tested or vetted against your income. You're not just being tested or vetted against your credit. You're being tested against a whole myriad of constraints, of which the property is one of them. And you going in saying you're pre-qualified, the bank doesn't know anything about the house because you haven't selected it yet. So really it is a pre-qualification is a general idea of what you might be able to afford as long as you can actually pass all of the tests afterwards.
And those tests, the tasks and efforts you need to make to assure that you're qualified or to bolster your
Let's get into this a little bit more. We got to go to break, Mike, and it's a great question. We're probably not going to get to all of our questions. Yeah, stick with us. This is an awesome topic, and it's super important for you to know this when you're going to go into a transaction. So stay with us on Hitting Home with Mike Arif.
Welcome back to Hitting Home with Mike and Arif, and we're talking about myths and misconceptions about the mortgage industry. And just to wrap up what we were talking about in the first segment, qualification, and one of the things I wanted to point out, it's not just the buyer that has to qualify, it's the property itself. Tell us a little about that.
Absolutely. Well, listen, to put it in a nutshell, and I probably will raise the ire of some people in the industry, but the fact of the matter is that a pre-qualification is a worthless item. It may give you a concept of what you could potentially qualify for, but here's what it really is. And it gets sold to you as, hey, listen, I'm doing you a good service. What it really is a marketing tool that says, I've now got you as my customer. Right? The bank's got you as a customer, or the mortgage agent's got you as a customer. I've pre-qualified you. You're going to stick with me. You're not going shopping anywhere else.
Exactly.
That's all it really is, because if you change one element, one little detail, the entire mortgage can change. So just because you were possibly pre-qualified on one property and you decide not to go with that property, that deal falls through because of a home inspection or whatever it may be, and you now go and buy another property, a lot of times clients will assume that they're going to be qualified or approved. They're not. You changed something, so now you need to look at the whole thing again.
And it is a competitive industry, banking and mortgage
Sure.
lending.
Yeah.
And one of the number one tools they use is, the big sign, the mortgage ad, whatever. We've got the best rates.
Yeah.
Should I count on that when I see that advertising and be jumping in the car and heading straight to that institution? Or?
Absolutely not. Every single deal or every single transaction is going to be judged on its own merits. And the way I look at that one, I mean, it's true. You drive by the banks and they've got that grease pencil on the window that tells you what
Which
the
is
rate
not
is.
necessarily the rate you're going to get.
No, and it's like driving to a car dealership or looking at the ads and they see, buy this car for this much, and you're not buying the car for this much. Now it's weekly payments or bi-weekly payments of. But if you look at the asterisk, it says one vehicle at this price. Other than that, it's a different price for the rest of the inventory,
Yeah.
right? So every single deal, put it this way, there are hundreds of banks in Ontario, hundreds, not just the 6 that you see on the street corner, hundreds. There's credit unions, there are institutions that are operating out of tall bank buildings in Toronto and they don't have any branches. There's the Tangerines of the world, which are virtual banks. And
So there's different overhead costs to each of these
absolutely, and they're all
establishments.
competing. So if there was one bank that had the best rate all the time, what would the other ones be doing in business, right?
Yeah,
They
true.
wouldn't be. So every bank has a different niche or a different market that it's targeting or trying to increase their market share on. So, and the fact of the matter is, a big misconception about banks, right, is that I'm going to get the best rate at my bank.
Yeah.
Here's the truth about the bank. And again, nothing against them. They're counting on the loyalty of their customers, that their customers are going to come to them and then they're not going to go shop around, right? And they're in our face all the time, right? They're advertising and they've got their branches on the corners. The fact of the matter is, though, that's an expense to them. That's overhead. And they've got staff that are overhead. They've got buildings that are overhead. They've got marketing that's overhead. Versus if you go to a broker, we're their overhead. Like we're their marketing.
Right.
We take all of that overhead away from them. So there's a good chance that with our buying power and our volume as a broker, we can actually work out a better rate for
Excellent.
you. But it's dependent on every single
Yeah.
transaction being different.
And the banking institutions, they count on loyalty of their customers. And part of that loyalty, I think, just comes from how ominous it is to get out there and shop around for a mortgage. Am I right in thinking that?
Absolutely, 100% precisely. I mean, it's about being comfortable, right? It's the devil you know, and I don't mean that against an institution in general. That's a common term, right? The devil you know. And plain and simple, we get accustomed, we get lazy, we get comfortable. And the fact of the matter is that, as I said before, you're going to do this transaction once every several years, and there's the whole idea, will I qualify? Do I have to go through my taxes? Do I have to do, how do I know I'm going to qualify? And the fact of the matter is that they're counting on that. 100%, they're counting on your level of discomfort to go elsewhere.
Right.
I'll just sign on the dotted line because that's the best offer that I think I'm going to get.
Exactly.
Yeah.
And when you are in there, whatever that lending institution is that you're working on, you're presented with different term options. Now tell us how that's going to impact on me as the buyer.
Right, great question. First and foremost, we talked earlier about the difference between fixed and variable or adjustable rate mortgage and plain and simple, and also open and closed, right?
Right.
Typically speaking, as I said, the difference between open and closed is if you want the flexibility to get in and out of your mortgage whenever you feel like it, that's going to be, you're going to want an open mortgage, but that comes with a heavy price, right? It comes with a price because the bank doesn't know that they've got you for an extended period of time, so they're going to charge you for the convenience of being able to get in and out early. A closed mortgage means you're committing to a length of time, whether it's 1 year, 3 years, 5 years, 10 years, whatever it may be, you're committing to that, and they're also going to spread their expenses out for the transaction, right? There are transactional costs for the bank in putting together a mortgage.
Yeah.
So they're going to spread that out over the life of the mortgage. If you're going to go shorter or open, they're going to charge you up front for that, right?
They need it back in a shorter time. Yeah.
Yeah, so in terms of 1 year, 3 year, 5 year, which are your typical terms that you get, it's a misconception that the shorter term is going to be cheaper or the shorter term is going to be longer. Every bank, remember I said there's so many banks out there, they're all fighting for market share. There are different niches that they're going to cater to, and so they're going to have a rate promo.
Right.
Because they want to drive traffic to their 3 year term or they want to drive traffic to their 5 year term. Maybe they've got investors that they're paying different amounts to. So different banks are going to compete and jockey for position, and they're going to have different rates based on the different terms. And it's not going to be all banks are cheaper on a 1 year or all banks are more expensive on a 5 year.
Yeah.
It's going to vary.
And the shorter versus longer, I've always thought that one of the influences there is which direction the market's likely to go. Are interest rates going to go up, or are they going to go down?
Right,
Can you
exactly.
speak on that
Well,
briefly,
I mean, listen, everybody's got the same crystal ball. They're using data, and they're using predictions, and they're using forecasting. They're also using how much cash that they have available at any one point in time. But the fact of the matter is that they're vying for business. They're jockeying for position in the marketplace, and it's a broker's job. You're coming to me so that I can scout the marketplace, kind of like a travel agent.
Yeah.
I'm going to scout the marketplace, and I'm going to have the most up-to-date information, and I will take you to the most suitable place. We got to go to break.
Yeah.
This is going by really quickly, but we've got a great third segment coming up, so stick with us on Hitting Home with Mike and Arif.
Welcome back to Hitting Home with Mike and Arif, and we're talking about mortgage myths and misconceptions, and we're in this third segment. I'd like to talk a little bit about one particular thing. If your neighbor or someone you work with, they come to you and they tell you, I just got a great rate. Should you be overly confident that you can go in and get that same rate, or how does that work?
You know, it's an interesting spin on that because you said it in such a positive light.
Yeah.
You know, most people are like, you know, my neighbor got this rate. How come I can't get that same rate? And we hear that, all right? The fact of the matter is that comparison is the root of all evil. You got to be really careful. I said this earlier, I'll say it again. Every single transaction is judged on its own merits, right? So are you your neighbor? No. Well, what are some of the differences? Now, you'd have to know your neighbor pretty intimately, and they'd have to know you pretty intimately. But what are some of the differences, right? How's your credit? How's their credit? Are you employed? Are they self-employed? Or are you both employed? Do you work? Are your lives mirror images?
Yeah.
If so, then you should be judged on the similar criteria or same criteria, right?
And those differences that you're judged on are ones that we don't commonly share in the workplace or with our friends.
No,
Those
we're
are the
pretty
things we
protective
hold
of our private lives, right?
close to the chest, those
Yeah,
information.
and that's the thing, right? I mean, you drive along the main street and you see the window sticker and it says, you know, mortgage is at this, right?
Yeah.
That's asterisk, that's on approved credit, OAC.
That's to get you in the door.
How many times have we seen the acronym OAC in our lives? It's on approved credit. So some of the things that make the change or the difference is, and there are so many factors, your overall debt servicing, right? So how much of your life, how much of your income is going towards servicing your debts, that being mortgages, taxes, insurance, heat, hydro, credit cards, lines of credit, card payments, and stuff like that.
Marital status would play into it, I
Marital
suppose?
status, absolutely, because remember, lending and interest rates are based on risk, right? So are you
Am I
married
at greater
and have you
risk when I'm single than versus when I'm married?
Yeah, you are
Okay.
actually. You are actually a little bit of a greater
wife would
risk.
agree with you.
Why? Because you could go out on a bender. You could go to Vegas. You don't have roots that are necessarily
Really?
tying you down and sending you,
Okay.
keeping you to sort of putting family and wife and kids first, and your obligations first, and making sure that you're going to take care of the home front.
Someone keeping you grounded?
If you could be nomadic, right? You might pick up and be a gypsy and run off and whatever else.
Okay.
Yeah, that's a risk to a bank. So believe it or not, if you've got kids, you're a better risk.
And your income type plays in it. I'm a realtor, so I'm more or less self-employed in the eyes of a lender.
Right. So how
is that
stable?
different?
You know, if you're unionized, or if you work for the government, or if you're a police officer, or
guaranteed
if you're a
weekly paycheck.
doctor, something like that. Yeah, it is profiling. I'm going to be blunt and say it. Whoever wants
insurance
to call me
companies
on
do
that
it
will.
too,
It's profiling, right?
Yeah.
So if you're self-employed, or if you're commission sales, and if your income is dependent on other people in the market trends, that's a risk.
Yeah.
So you're going to be quoted based on that. So income type, marital status, property type, and location. That's a big deal,
one.
right?
Yeah.
Mike, you've seen this. I know you sell properties both in the city and outside the city. There are a lot of people who are, dreaming of acreage still, right?
Yeah.
And they'd like to live on a farm or have a shop, right? Well, that comes with its own risk. One, well and septic, right? It's expensive if the well and septic goes. Two, if you're on city-regulated water, the likelihood of getting sick or toxins in your water versus, maybe the impact of agriculture on your water system, right, can be a risk.
Yeah.
But the other thing is, how marketable is the home?
Yeah.
If things go south, if things don't work out, how quickly can the bank turn around and sell your house? That is a risk to them.
And it's not just geographical variances either. You could have two homes side by side, built in the same year by the same builder. 25 years later, there's market differences between those two homes. One of them's going to
Absolutely.
need a lot more work, and the other one's been kept up in the eye of the lender and that appraiser.
Yep.
They're going to have.
For sure, that's
Yeah.
going to be a difference, and yeah, what is the marketability of it? But perhaps one of the biggest misconceptions out there is, my neighbor got this rate, why am I getting that rate? Well, one of the questions is their mortgage insured?
Well, insured
Right.
versus uninsured. I wanted to touch
So
on
people
that. Yeah.
always say, oh, you got to put 20% down. That's better if you put 20% down. Sure, you're putting more skin in the game. You've got equity in the game.
Explain the CMHC. There's the 20% for those who may not know.
Yeah, the government makes it available for us. Typically speaking, the Bank Act and whatever restricted people and banks from lending more than 80% of the value of the home. And that was designed to protect investors, et cetera. The government said, well, and this is a while back, the government said, well, listen, you know what, we need to make home ownership accessible for people with less than 20% down.
Yeah.
But we can't put that burden on the investor. So
More
what
and more
we'll
important
do
with today's prices.
is we'll allow you to put down less than 20% if that purchaser buys the insurance policy, known as CMHC or mortgage default insurance or Genworth or
Genworth, yeah.
Canada Guarantee. Those are the three offers of mortgage default insurance. And it's a premium that you will pay. As a borrower, you will pay a premium over the life of your mortgage, the amortized life or the stretched out, pay it down to zero life of your mortgage, right? And in return for that, what does that do? It takes the risk off of the lender that if the borrower goes into default or loses the home under power of sale, that insurance premium will make the lender whole. And then the insurance company will deal with the borrower to see if there was fraud or if they can recover, right? But the simple fact of paying somewhere around 3.5% to 4% mortgage default insurance, so whatever your mortgage amount is, add 4% on top of that, you're going to pay it over the life of your mortgage.
Right.
That gives the lender security, and because of that security, they're going to extend a preferential rate, right? So anybody putting down 20% or more may or may not have to pay insurance, and I say it that way on purpose, may or may not pay some form of insurance, or the lender may or may not apply some insurance to them.
Okay.
But typically speaking, the rate's going to be a little bit higher because the lender doesn't have that added security of the mortgage being insured.
And
really important.
Yeah, and in addition to the amount of down payment, a lender is typically, in assessing me, going to look to see, have I had previous bankruptcies?
Yeah.
Some of those black marks, and maybe you could list some of them that are being looked at. Are you scarred for life with that? Can you heal? Is there a reset button? Tell us a little bit about how that process
you know, it's a great
works.
question. I'm glad we're ending up on that. We have a very little amount of time on that, but let's touch on it. Plain and simple, the short answer is no, you're not scarred for life. Is it going to be impossible? No. There's chances are no. As long as you learn from whatever the challenge was, and I'm saying it's a mistake, sometimes it's just life happened, right? But there are a variety of lenders. As I said, not all banks are created equal. There are a variety of lenders. Some will let you get in back into the home ownership or mortgage market the very next day after you clear your consumer proposal or your bankruptcy. The very next day. Now, you might pay for that. It might be more expensive because, again, that's risk. Okay?
Yeah.
Some require 6 months or a year, some require 2 years, and some banks say, sorry, we're an extremely conservative lender and we don't touch them.
And
that's reality,
yeah.
but there are so many lenders out there.
In addition to just time, are there things I can actively do that's going to help speed that healing process up in the eyes of the lender?
Yeah, and it goes right back to the basics. Meet with the people in your life. Here's the simple answer, Mike. You probably didn't get into bankruptcy or consumer proposal overnight. You probably worked on it through a series of unfortunate decisions or bad choices or life happening to you. So it probably will take you a little bit of time to get out, but work with the right people in your life. Put a good team of people around you. There are habits that we can talk about, how to get credit rebuilt, how to get some consistency, really scale back on the wants versus needs part of your life. And yes, we can rebuild you.
Excellent.
Yeah, and at this point, we're out of time, Mike.
We are.
This
and
went by so fast.
And I would advise people get in and have a chat with her if you want to know more or embellish
Happy to
a little
speak
bit
with
of what we talked about.
Doesn't
I've learned a
cost.
lot. I hope you've all learned a lot. And I thank you all for tuning in to Hitting Home with Mike and Arif.
We'll
Thank
see you
you
again.